Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you guys all along with us. Angie has some very exciting news, so I will turn this over to her first and foremost.
I know, it is exciting. And for years, some of the families that we take care of have said, hey, do you have anything, for the kids? And so we have rolled out it's actually called Getting Ahead of the Game Summer Series. It's going to run from June 29th to July 2nd. So it'll be 4 nights, 4 evenings. It's divided into 2 age groups. And so the kids
So the age groups are 8 to 12, and then another group for people that are 13 to 18.
Yes. So it's age appropriate. And they'll be, the younger group may cover things like how to save, spend, and give away. And the older group will be doing things like learning to write a check, read their paycheck stub, and even introduction to investing. So it's all about teaching them more about personal finance, which they don't get anywhere else,
right.
Like not at school.
This is year 20 for me doing the radio show. Angie's been around for the last few years helping me do it. And, I've had a lot of people over the years at homeschool who have asked me to put on courses and classes. And I really feel very, very cool about this. We put on a challenge a few weeks ago for adults to understand the 5 critical elements, things that you and I talk about on this radio show every week. This Getting Ahead challenge really is for the kids, and kind of what you've heard me talk about, Angie. It's we've got a lot of kids that are going to inherit money, and the bottom line is nobody has taught them what to do with the money when they receive it. So we work with trust and things like that to make sure that we have as much control as we can. But this program really is about trying to give them the education and a foot up of understanding what's going on. So we have 5 or 6 of our financial planning team that participate.
5 of our team members are going to do it for the 4 nights. Some of them are going to kind of join together. And for the younger group, it'll be at 6 o'clock. And for the older group, it'll be at 7. And they're 30-minute classes. And the great thing is we also want to teach giving at an early age. So for those who complete all 4 nights, we're going to be able to donate to their $50 to either a favorite teacher, classroom, or a charity or school organization, something that would be a 501c3 for that child. And
it's going to be great.
And
It's neat. It's neat, and you've got Grant and Adam and Chris and Jamie and Dean that'll all be participating in this. Darren actually taught school for 14 years. As you know, we have a lot of educators in my family, so it'll be great. Don't forget, it's for the parents and the kids. The parents, we're going to give you notes as to what to quiz the kids on. Give Angie a call, 800-928-4001. Get signed up for your Next Steps meeting.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This Program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
You have done the heavy lifting. You have saved for retirement, accumulated assets, and now you may be wondering, how much can you take out of the account and still be okay, meaning that you still have money when you still have life. Welcome to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
We are happy to have you along. And folks, that is really the question that we're going to answer for you today. How much money can you take out of an account? And Angie, kind of what we've talked about on this show for years and years, you are unique. You are not average. The years that I taught at Purdue University and 7 years, 14 semesters, and we did the academic research and work to be able to create the 5 critical elements which are trademarked in our family focus process. The work that we did there was based on averages. And there's a lot of averages that are out there that I think confuse people about their finances, because when you're talking to somebody, most of the time they want to sell you something. I mean, that's just the way it is. I want to, if we don't sell products, we don't use that, but we're looking for people who want to raise their hand and say, hey, Joe, I would like somebody at the Financial Enhancement Group as a fiduciary, somebody who's legally obligated to take care of my money like I would take care of my money if I knew what I was doing. I would like to have somebody to do that for me. And that's what the Financial Enhancement Group does too. So we have a bias toward you saying, hey, this is the place that I belong. I want to come in and talk, and you can give Angie a call if that fits your bag, 800-928-4001. Come in and get signed up for a call where you can, or a meeting where you can sit down. And we call it the Next Steps meeting. We will give you things to consider today. The team will give you things to consider in the future. And if we choose to partner together, things that you're going to want to consider into the future. But the key thing here right now is if you're listening to the show, we want to make sure that you understand that you are indeed unique. And Angie's got some questions that she's going to ask about that, because a lot of people get confused. When you go on the web and you start looking at research, you're going to deal with the masses. We want you to deal with you.
And one of the big questions that we always get is, how do I know I'm going to have enough to retire? And one of the things we've heard about or read about, and I'm sure everyone has, is a strategy called the 4% rule. What can you explain that? How is it created?
So Dr. Blitzer is the gentleman in charge of the S&P 500, meaning he's the one who gets to pick when companies get put in or pulled out of the S&P 500. For instance, you may have seen in the last couple of weeks, Nordstrom, Harley-Davidson, both pulled out of the S&P 500. One other company, I'm not remembering that right now that it was, but that's his choice, he and his committee. But at the end of the day, he's got the choice. And he made an argument looking between 1926 and 1976. That's a long time ago, folks, right? But looking at that period of time, that a person could have taken out 4% every year out of an account, 100% invested in the S&P 500, which honestly didn't even exist in that form in 1926. He went back and looked at a chart that actually showed all asset classes to be able to do that work. And what we have found in our practice when we look at it is that's too much money for some people, and it's not enough for other people. Bottom line is you are unique.
Well, and that's the thing. Depending on your family and what's happened, there's all kinds of different things that pop up. So I guess a question would be, does the 4% rule allow for what does it not allow for that could happen?
The biggest thing that I have seen in my career, when I became a certified financial planner and was trained by educators and professors, and obviously, in all fairness, I was wet behind the ears. I did what I was taught by academics. I did what I was taught by people who'd been in the industry. And so we followed the 4% rule to the best of our ability. Today, I have a bunch of 90-year-olds with a whole lot of money and not a lot of life left because I followed rules that I was taught instead of understanding what happens. Today, 32 years later, being a financial professional and a fiduciary, we recognize that each person's life is unique. But what happens this period of times like 97, 98, and 99, where the market has unprecedented growth, accounts double, and people say, hey, I want to take out a lot more or take out 4% of an account tripling. You can't, or doubling, you can't do that. Markets get overvalued, they get overextended. In 2008, we had people who insisted on taking less money because the market was down. Those models are designed to allow you to get through thick and thin so that you don't have major income disruptions every 6 months. Once every 3 years, Angie, is one thing. But it does take care of normal inflation under Blitzer's model if you buy into it. It does not take care of hyperinflation, which I am very concerned with.
Well, I mean, how do you know how much you can take and not run out? How do you figure this out?
So here's where it really depends on you as a unique individual, your goals and objectives. Adam Harder, our CFA, our Chief Investment Officer, went through and did some work with our practice, and it's about 11% of our people of our accounts actually take what we call a classical distribution. A classical distribution is where people are taking money for their income. It's not going to run out. They're not going to have to worry about handing the last dollar to the mortician. That's not their thing. And we're prepared to do that. And the percent that we use is based on the age they are. If you think about an evergreen, if you think about a baby maple, and if you think about a 100-year-old oak, right? We have all three of those in my backyard, right? And when you look at them, you have to treat them differently. I do not have to water my oak. God takes care of that, right? But in the summer months, until this maple has taken root, I need to be out there watering it and taking care of it like I do the birds, right?
Yeah.
I mean, it's different. The evergreen, I'm not sure you ever need to do anything. That puppy's just going to grow until probably I'm gone, if you want to know the truth. The oak may very well do it as well. But all three of those have leaves of different natures. All three are deemed trees. And, when you get into distribution, we're all the same humans, right? We're all Homo sapiens. We all have that same soul, heart, mind, and desires may be different. And your goals are different, but your ages are different too. And what we find are there are people who take the classic distribution. As they age, in all fairness, when they start, the different percentage they can take out. And Adam and I are going to write a whole paper on this, which you'll be able to get if you call Angie at 800-928-4001. It'll be out in about 6 to 8 weeks, but you'll be able to get a hold of that. But number two, you've got people who use the bridge technique. One of the things that we try to help people do is to understand that they can take out money over an accelerated downturn, if you will, an accelerated amount of withdrawal for a limited amount of time so that they can allow their Social Security benefits to accrue. A big part of what we do at the Financial Enhancement Group is helping people understand what their Social Security options are as it relates to the investments they have, not just the silo, if you will. And then there's some people, Angie, that have the spin down. And the spin down, quite frankly, is the ability to say, hey, when I'm gone, I really don't want to have a lot of money left. Now, you can never get it to zero, but you don't want to have a lot of money left that you're not trying to leave behind a beneficiary. So you have classical, Angie, you have bridge, and you have that spin down. It's different for different folks.
Well, and I guess that's it for that segment. But if you would like to come in and just talk to us about any of these things, please give us a call at 1-800-928-4001. We'd love to sit down with you, any of the advisors. We work as a team. And also, if you'd like to sign your kids up for the classes that we were talking about, you can also go to our homepage on our website at yourlifeafterwork.com. And we have a button. It's super easy. It's an easy button. And you can just sign them up that way.
So give Angie a call for your next steps meeting. 800-928-4001. If you come in, we will give you in a 90-minute meeting things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. Don't forget to go to the website, yourlifeafterwork.com, to get signed up for the Kids Challenge. It's going to be awesome. Or give Angie a call, 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own. If they were in your situation, there are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Who in their right mind would intentionally try to recognize a loss in their investment portfolio? Well, if it's an account that's not tax deferred, like an IRA or a 401k, you're talking to them. Joe Clark, Financial Enhancement Group. We harvest losses every time we get the chance because it will make your investments better and your future decisions even stronger. Welcome to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Now, I've got to tell you, on behalf of Angie, she said, Joe, it has not been that long ago since we talked about tax loss harvesting. And, she tries to keep the content fresh, and I get it. What she doesn't necessarily get to see is day after day, week after week, we have more and more of our families come in now that we're actually able to see eyeball to eyeball. I actually hugged somebody today. And we're able to do that and talk about tax loss harvesting where we weren't able to talk about that in, let's say, March or April, right? And we live in an unprecedented time where the market has had a very extreme downturn, down as much as 40%, a little bit more so in some cases, and an uptick now to where we're, in some cases, above where we were at the beginning of the year in terms of the market. And in terms of quite a few stocks, quite frankly, not the majority, but quite a few. So we're going to talk about tax loss harvesting. I'm going to turn it over to Angie. She's all things Consider This program. So if you have a question or comment, you can email her, Consider This program. There's a place where you can go to our website at yourlifeafterwork.com, submit a question. We are happy to answer that on the show for you as well. So Angie, fire away.
Well, we know that tax loss harvesting is a strategy to help you minimize your capital gains, but can you explain how it works?
Yeah. You've got, you have two different types of gains in a portfolio. You've got what we call short-term gains. That's when you buy a stock or a mutual fund or an ETF that is less than a year old. You've held it for less than a year.
Okay.
And then you've got things that you've held for a year and a day or longer. If it's a year and a day or longer, it's called a long-term capital gain when you sell it.
Okay.
And if it's before, it's called a short-term capital gain. So what happens? We're meeting with a gentleman later this week that came in off of the challenge that we had, the Get Smart About Your Retirement Challenge a few weeks ago. He watched us for 6 nights and said, hey, this is what I want. And he's coming in, and he mentioned in his thing that he's got some stocks that he bought back in 1987, right?
Wow.
When I started my career. So I can tell you that was 32 years ago, based on when he bought it after the crash that occurred in October. I'd started in this industry 2 weeks prior to that. And he's got some extreme long-term capital gains, the same as we do in some of the individual stocks that we bought in the mid-2000s at the firm. So what happens with capital loss harvesting when we have periods of time like we did in March, April, and the first part of May, when we watched that market really, really struggle and go down, and there were companies that we knew that we didn't want to continue to own because things had changed. We didn't sell them, and you need to understand that. We didn't sell them in entirety just because the price of the equity went down. But there were fundamental changes in that company, in the macro or micro economy, or both, because of the pandemic, where we went in and made changes. Many times we're actually able to go in, sell something, and buy something very, very similar, where we're able to capture a loss. Now, Angie, what that lets us do is keep from being trapped, like the gentleman that we're going to see later this week, because we harvest losses in other things, not because we want to just intentionally take a loss.
Right.
But if we can sell something, capture a loss, and then turn around and use that against things that have gains in it, but we don't have to put on our tax return, that is a beautiful thing. Now, keep in mind, Angie, when we're talking about a capital loss, this never deals with IRAs or 401ks. This is money that you have that's after tax.
How much can you use a year?
So you can use all of your losses up to all of your gains plus an additional $3,000. So let's say you are in the 20% tax bracket, okay? and you have a $1,000 capital loss,
Okay.
right? That is $200 that you're able to put in your back pocket. It's $200 of income that you're not going to pay taxes on. If you happen to be in the 20% bracket, which there is none, there's a 12 and then goes to 22%. But if you happen to be in 20, we'll just call it that, you would save $200 in taxes. You can do $3,000 a year, Angie. So
Okay.
you could save if you average in the 20% bracket, and it's really not average. This is your marginal rate. It's whatever your top tax rate is. You could save whatever that rate is times up to $3,000. So if you're in the 25% bracket, for instance, you're saving $750
Wow.
in taxes just by taking that off of your return. So we harvest it when we're given the opportunity.
Now, if you're going to carry these losses forward, how long is that?
Forever. They never run out. Now, one of the things that is often missed is if you file a joint 1040, it is a spouse and spouse relationship. If one of the spouses die, in theory, half of those capital losses disappear at death because you get a step up in basis on half of those gains as well. Now, I've had CPAs argue both ways on this as I read the code. I am not a CPA. I'm a CFP, Certified Financial Planner. So it's between you and your accountant, but as I look at it and as I talk with people who are really in tune to this, most of us tend to agree that half of those losses should be written off upon demise.
Now, did the CARE Act change anything with the rules?
The CARES Act changed a lot of things, a lot of rules that are out there, but not necessarily about capital gains. More of the stuff that was changed with it is inside of the IRA distributions, the ability to get money out with a 10% penalty in the event that COVID actually impacted you, the ability to pay the taxes back out of an IRA or 401k distribution over 3 years as opposed to 1 year, but changing the capital gain environment itself, not so much.
You talked a little bit about long-term and short-term capital gains. If you're looking for losses, which one of those should you focus on?
Well, the way we go, most people will tend to look at getting a short-term loss first because it goes against the short-term gains that are there to be able to do the offset. I think it really, again, gets into the tax nature of how it's reported. That a short-term capital gain is taxed at your marginal rate. That's higher. A short-term or long-term capital gain is taxed at a preferential rate. Preferential meaning that it's at a lower rate. So your maximum rate in the United States as of 2020 could be 37%.
Mm-hmm.
On the other hand, your largest federal capital gain rate is 20%. So those preferential items do come into play. Those are things, by the way, that Angie is not going to talk about during the Kids Challenge.
No.
So if you missed this in the beginning, right, we like to teach. I have 29 at one point in time, 29 public educators on my mom's side of the family. So the way our business model has always worked is we show up on time, we do what we say we're going to do, we say please and thank you, we treat people with respect, and understand that you did the heavy lifting. Our job is to try to guide you through those next steps of your financial journey based on 32 years of experience, a team of 29 professionals acting as fiduciaries, not selling any products. In the meantime, we want to educate you to the best of our ability. And Angie, along with our planning team, have put on a Get Ahead Challenge that's coming up this next week.
Mm-hmm.
Starts Monday night, June 28th.
June 29th,
June
and it'll
29th.
run through that Thursday, which is July 2nd. So
There you
there'll be
go.
a nice big vacation.
6
following.
to 6:30 if you're 8 to 12 years old. 6:30 to 7 if you're 13
It's actually
to
7 to 7:30 if you're in the older group.
Well, there you
We're
go.
going to actually give our producer a chance to set up.
Hey,
for the
I
next
like
group.
it. I like it. You've got our financial planning team that's coming out that will work with them. Go to our website at yourlifeafterwork.com. The main button right there on the page. Get signed up for the Kids Challenge. Happy to have you along. If you're ready to sit down for your next steps meeting, call Angie, 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Do you have a hole in your life insurance? Folks, there is nothing I can imagine more painful than paying premium after premium after premium, suddenly getting up in years where you may actually try out your life insurance, only to hear an insurance company tell you, "We're sorry, you're out of luck." Hey, you're listening to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
For those of you who don't know, this is a financial planning program. I am the managing partner and a certified financial planner of the Financial Enhancement Group. We're registered investment advisors. That means we act as fiduciaries. We do not sell things. We have to treat your money as if it were our money and we were in the same situation. We get a lot of calls. In fact, we got a call today over a life insurance policy that has a problem. So we're going to try to break that down for you to at least put you in aware of situations that could be happening to you, your elder parents, hopefully not your children in this case. But this does happen a lot to mom and dad. That was the phone call today. And it does happen a lot to people in your age that have owned insurance policies for 10 to 20 years or even longer.
We've had questions come in, and it seems like quite a few of them are about the variable life insurance. So do you want to explain just quickly, like, how does that work any differently than term or?
Fair. So one of the things you need to know, effective July 7th, that's coming quickly, 2020, we will now be doing a streaming show. You'll still be able to get this on WIBC and Shine and Wilo. Whatever time you're listening to the program now, you'll be able to get it. If you're listening to the podcast, you'll be able to get it wherever you want it, iTunes or wherever you listen. But if you're around on Tuesday evenings from 5 to 6 p.m., you'll be able to hear Angie and I as we produce the show on a streaming video. You'll actually be able to interact and ask questions. If you do it that way, it's going to be really, really neat and really, really cool. And I would normally have my whiteboard in front of me to try to answer this. So, Angie, when we talk about a permanent policy, that is one that is designed for you to die with. Okay, that's what permanent means. Whereas term, by definition, is covering a period of time. Typical terms are 10-year or 20-year level terms. So we're not going to talk about those per se. But when you talk about life insurance, and in this case, not whole life insurance. What I'm talking about is variable universal life, what's commonly referred to as VUL, and universal life, so no V in the front, universal life. They both have problems, and oddly enough, for opposite reasons. So when you have either one of those types of life insurance policies, either a variable universal life or a universal life, the chassis, the hard drive operate in the same manner. You pay in what you believe to be premiums. And Angie, we're going to come back to this in a minute because technically you're not paying a premium. You're making a deposit. And to understand this from both a tax perspective and how the chassis works, you need to understand that you're putting in a deposit. The insurance company has given you a suggested amount of money that you are supposed to pay in. You have made an election. And the insurance company is going to send you sheets of paper that look like premium payments, right, that are designed to remind you what you said you wanted to put in. It's important to get that. So you're going to make deposits. Now, that deposit is going to go in a bucket that has a divider in the middle. The divider, the way I show it in my class, is on the left side. The divider on the left side is where you're putting money into your investments. If it is a universal life account, you're putting it into fixed rate investments. The insurance company is going to tell you what rate it's going to earn for the year, and you've got a fixed rate investment that you're going to get, a percentage. So think the interest rate environment, which right now is very low, historically low, as in lower all the way back to literally, we can go back 800 years of data We are the lowest we have ever been in terms of interest rates. That means if you have one of these universal life policies that you've had for an extended period of time, there were assumptions that were made where your internal investment would probably be greater than your actual result. And we'll get back to that in a minute. The second one, when you hear the word variable, Angie, that means it's going into what we call separate accounts by law. They look, act, and smell like mutual funds, but the point is they're equity and bond type funds that are in there that you have your money divided up against in those two areas, if you will, to be able to create returns. So the deposits went in, and they either went into that fixed rate environment if you had a universal life, or into mutual fund investments, mutual fund looking like investments if you were on the variable side. Now the problem is that's one half of that divider in that tank. The other half has a hole in the bottom, and that's not a bad thing. That's how it's designed. You knew that from the beginning. You just may have not understood it. That hole at the bottom of the right-hand side of my picture, if you could see the whiteboard, would show the amount of money coming out is based on the cost of the insurance for that year for the amount of face amount. So face amount's the death benefit you selected. So let's say Angie had a $250,000 life insurance policy. That would be the face amount, right? And based on her age this year at 32,
yes,
those are the right numbers, right? At 32, based on those numbers, there is a cost of insurance. Whatever that cost of insurance is billed to the deposits. Remember, you didn't pay premiums. The premiums did not go directly to the whole. They went directly to the investments. The investments were billed for the amount of money that was required. That way, you actually never see what the cost of insurance is. Okay? Now, the cost of insurance is taken out. In some cases, that includes the death benefit, that includes the amount of cash already accumulated. In some cases, it doesn't. As you get older, the cost of insurance grows. Now, the idea is that you are putting more money in that policy than what is necessary, so that as it grows, you need to pay for less and less insurance, right? Because your deposits have grown so much, either because of the fixed rate inside on the universal life or the variable side with the separate accounts. One way or the other, you were putting in enough money to do it. Now, Angie, let me ask you a question. Angie likes to buy houses. Yep. And fix them up. She likes to do that. I don't. We have an opposite role in the sexist world we live in, because I would never even think about doing drywall that she's very good at. So you can buy a house for $100,000. You can buy a house for $70,000. It appears to be the same house on the outside. Which one do you want?
The one for $70,000.
Because you understand that, right? They look identical. They're both 3-bedroom. One's 70, one's 100. I know what I'm getting today. I can walk into the door. I've got to do some painting, carpet, and whatever it is you flipper people do, right, to make it better so that people want to go in and buy it. The problem was with the life insurance policy, it is a very sophisticated investment, even universal life that is fixed, let alone the variable side, right? They're both very complex instruments. And what happened is the insurance agent said, Angie, you can put in $150 a month or you can put in $250 a month. Which would you prefer? And you scratched your head and you looked at him and said, let me get this straight. I can put in $150 and I can have $250,000 of death benefit for my kids if I die today. Or I can put in $250 and have the same amount of death benefit. And the agent goes, yes. And you go, well, I'm no dummy. I'll do the $150, right? So the insurance agents and the IRS both allowed you to have additional funds that were able to go in to build those deposits higher so that the cost of insurance would be less later on. The problem is because you didn't understand, and the insurance commissions, this is why we get into trouble when we buy products from talking to non-fiduciaries, well, the insurance commissions are loaded based on that $150, not the $250. Right? The $250 is just extra additions. They don't get paid a lot. As a result, most people don't put in the money. And folks, you could very easily be getting a Dear John letter and not even knowing it that says, Dear Miss Kinzer, your deposits have run out. Your cost of term insurance now at the other 32, right? Switching them around. Your cost this year is now $1,800 a year. And you go, what? Right? I can't afford it. Policy lapses. Insurance company pays nothing. The insurance company made money. The agent made money. Angie did not. You need to be aware. Give us a call, 800-928-4001. We'll help you understand it.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Life insurance has holes in it. Now, that doesn't mean it's necessarily a bad thing. Generally, the hole is a lack of understanding, a lack of communication between you and the agent that sold it to you. Welcome to Consider This program. I'm your host, Joe Clark.
I'm Angie Kinzer.
For 32 years, I have been in the financial services industry and actually started in the life insurance side. So I understand the things that I'm talking about. These contracts that I'm talking about, I used to help people buy. All the way up until 1998 when the Roth IRA came into existence and most people no longer needed them the way they needed before. Life insurance has some extreme tax benefits, but it also has some extreme challenges. You've got to understand how these work. And apparently in our last conversation, the last segment, the DJ made an error. Angie informed me that I answered no questions and just went on a narrative explaining something that is very deep and passionate to me. The first time we watched the Dear John, and in this case it was the Dear Jane letter. My cousin, who is much older than I am, who I did not take care of, the husband actually married into the family. I love him dearly. His wife, my cousin, got cancer. They had a life insurance policy that they bought probably when I was in my single-digit years, right back in the early 70s, maybe as late as 78, somewhere in a period of time where interest rates were very, very high. And she had bought and he had bought a universal life insurance policy where, just as we talked about in the last segment, and if you missed that, don't forget you can go back to my podcast, Consider This program. You can get it. You can also go to our website at yourlifeafterwork.com to get it. But they put in the minimum amount that the insurance agent let them put it in. Interest rates went down, not up. They had less money in it than what they were thought they were supposed to have. She's within a year of passing away, and all of a sudden the life insurance premium, the deposits ran out. The premium was far more than what they could afford to pay, and there was a major challenge where she almost died without any life insurance money that they had paid on for over 30 years. Very, 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 very tragic. That's what drives me in this conversation. Angie, go ahead and ask your question.
So you're talking about it being tied to interest rates, but what about...
Universal life is interest rates.
Right.
Variable is in the investment side.
Okay, so how's a variable universal life policy impacted by a drop in the market?
So what happens is, if you've heard this show before, we talk about the three phases of finance: accumulation, preservation, and distribution. And we talk about how you travel through that life. Each of those phases are different. They have different objectives, right? So in accumulation, when you're starting to save money, what you're looking for is saving the right percentage of your income and building tax diversification, all right? In preservation, it's about getting the average return. That's where you have to really be true to your risk tolerance, to your investment policy statement. But you've got to be there beginning, middle, and end to get the average return. In distribution, Angie, it's all about your tax rate on your average dollar you pull out and the volatility between distribution points. Those are your two objectives. Now, what happens in an insurance sale? I know this because they trained me 32 years ago. What happens in a life insurance sale when somebody buys a VUL, their variable universal life, the agent looks at him and says, "Now, Angie, you're not planning on dying tomorrow, are you?" No. And so this is a long-term investment for you. And that means that we have the ability to put these investments in at a higher risk tolerance, if you will, more aggressive than what we might put your IRA or your 401k. And on the outside, if you don't understand the internal workings, on the outside, that just makes sense, doesn't it, Angie? right? The problem is, if you go back to that last conversation that we had where I broke down how these policies work, if you go back and look at it, you need to understand in life insurance that it's in distribution from day one. Remember, the money goes into the deposits. The insurance side bills the deposit account. They don't bill you. They're only taking out what they need for the cost of insurance. They're billing the life insurance policy for the cost of insurance. By definition, that is distribution. And so in volatility, when a market goes down, whether this is your 401k or your IRA when you're at retirement time taking it out, or it's your life insurance policy, the day you buy the blasted thing, when you're taking money out of it and the market's down, it never gets to recover. So premium payments you made in March and April of this year, you spent probably 20% or 30% more than you needed to when that money came out. Now, there's ways around this, but you really need to understand the internal workings.
As far as fees go, are they more with a VUL than they would be with a regular universal life?
They are, because the investment managers in the separate accounts are going to charge money. The cost of insurance by itself should be neutral. That's going to be based on the carrier. The chassis is generally a little more expensive on the variable because you have the investment options that are there. But the investments themselves are more costly than what you're going to find in a universal life. That would not be the part that would make me decide which of those two contracts that I wanted to have if I were to buy one.
Now, what's a typical surrender period, and what if you needed or wanted to get out of it early? How does that
So
work?
there are no-load life insurance policies that exist out there now that we're able to talk about. No-load just means there's no commissions, right? So we're able to help people try to figure that out. We've got people we work with in Indianapolis when people need term policies. I have term policies on my life. I don't have any permanent insurance based on where we are in the tax code right now. I can't say that will be that way forever. I can just tell you that it is right now that way. But when we, as we look at this and move forward in our lives, we have to be able to make changes and know where we are. But you want to pay attention to the fees and expenses for sure, the taxes, and just note that your life changes.
Now, will the payments always be a set amount or?
Well, and that's what we talked about. Remember that you're putting in a deposit. So you always have the right. And when people come in, if they call you for a next steps meeting, right? It's a 90-minute meeting that it's an offer that we put out where you're able to call Angie at 800-928-4001.
Yep. And you can say that you're ready for a next steps meeting. You can come in, sit down. We'll give you things to consider today, things to consider tomorrow, and if we choose to partner together, what FEG can do for you.
And our planning team, Angie's going to send you an email that says these are the things to bring in that you want reviewed.
Mm-hmm.
One of those will be life insurance policies. And we'll tell you specifically the things that you need to be aware of so you don't get a Dear John or Dear Jane letter in the mail like happened to my cousin that says this is a bad plan that is coming in. It's one of those things that's checked. It's very hard to talk about this over the phone because you're talking, or over the radio because you're talking about everybody. What we really want to look at is the specific people that are out there, your specific situation, so you understand what it is. But we will call the insurance company on your behalf to find out how much money you actually can put in the contract so that, Angie, you can increase your deposits today if you wanted to make sure that policy doesn't run out of money later on. Or we can say, hey, what if we just bought a term policy today, reduce the amount of money that we're spending on this policy, and try to make lemonade out of the lemons that we currently have.
Well, they start out with some kind of a death benefit.
Right.
Now, does that always stay the same? Can that be reduced?
The death benefit can be reduced if you need to because the deposits have decreased because of bad investment results, or in what's happened in most cases, not bad investment results as much as bad assumptions, and policies being treated like they were long-term as opposed to being in distribution, which they really are. Folks, all of this stuff works in unison. I think one of the big mistakes is that people have life insurance agents, they have CPAs, they have attorneys, they have financial planners, and they have investment brokers, and then they've got the side account from Aunt Millie that they try to play on. What we try to do is to help you understand that all needs to be coordinated. No different than a football field where you've got wide receivers and blockers and running backs and quarterbacks and guards and centers, and we all do different things. No different than that. You need to understand all of that money works together, but those 11 men on a football field at one time 22 when you have both teams, are fighting against each other to move the ball. What you're trying to fight against are fees and expenses, risk and volatility. You're trying to fight against inflation. You're trying to fight against taxes that are going to take money out of your nest egg. That's what we're going to try to help you prevent. Call Angie at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for a Next Steps meeting.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Some New Year's Eves are happier than others. You know, my mother-in-law has never been with us on New Year's Eve. She goes to bed before it happens and hates that song, Old Lang Syne or whatever it is. She just hates it, right? You know, why would you want to get rid of your friend? I get that, right? I understand that. Hey, folks, this year, we are still going to have a happy new year. 2020 is going to be gone, and I think a lot of people are going to be quite happy. However, there is going to be a year where Joe is not going to be so happy. That year is going to be December 31st of 2025. You may be wondering why. We're going to answer that for you. Welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Angie, it's December 31st, 2025, and Joe is not happy. Why?
The sunset.
The sunset? It's midnight. We're in Indiana. The sun set long ago.
Nope. You're going to have to explain what the sunset means.
Okay. December 22nd. Of 2017, one of the largest tax packages that was ever created came into being January 1st of 2018. It lowered the top tax bracket from 39.6% to 37%. It kept the lowest tax bracket at 10%, but it also added a 12% bracket instead of a 15% bracket. So some people say, well, Joe, that's only 3% difference, 15 to 12. Really, folks, that's about a 25% difference. It's huge. It is a phenomenal tax break. More so, corporations went from above 30% all the way down to the 21% area, right? So big changes that occurred in the tax code. Big changes that occurred in many different places, including estate taxes, the way the standard deduction worked versus itemized deductions, all sorts of incredible things. Now, the problem is the tax code sunsets December 31st of 2025. What does that mean?
Is it not permanent?
It is not permanent. Well, first of all, we know nothing is permanent in the tax code. When you hear the word permanent, it merely means they have to vote to remove it.
Right.
When you hear something that says sunset, it means they have to vote to keep it in. So during my tenure at Purdue University, where I taught the senior level, the capstone course for financial planning, I did that for 7 years, got to teach 200 and change of some of the brightest students that I could find. I miss those days, quite frankly. 5 of them work for the Financial Enhancement Group now. They're still part of the 29 people we have on the team, one of which is even a partner. We're able to sit down and continue this communication and teaching. But while I was there, I created a curriculum, then had it trademarked. We call it the family focus process. So when you come in to see us at the Financial Enhancement Group, what we're going to help you walk through is a financial vision that says, here's who you are and where it is you're trying to go. The older you are, the more important that is, but we try to do it with all families. But we're going to walk you through the 5 critical elements, and I call them critical because if you mess up one, your work in the other 4 can be destroyed. I mean, it really can. You can do everything right in your health and not sleep, and you're going to die. Right? You can do everything right with your nutrition and not drink water, and you're going to die. It's just the way it is. We know with our work, with our jobs, with our family, you can do a lot of things right, do one thing wrong, and die. You know, James Clear, my favorite speaker on habits, made it very, very clear last year in a book I wrote called called Atomic Habits, and reread actually. And it very, very, very simply said, success is never dependent upon one thing, failure can be. And I'm telling you the 5 critical elements. You can have success in 3 of those and fail, right? You can fail because of the other 2, or the other 1 can destroy everything that you got right. You can't get 1 right and be fine. It just doesn't work. Success is never dependent upon one thing, failure can be. So what are the 5 critical elements, Angie? Well, the first one is yourlifeafterwork.com, right? That's when you're going to take distributions. So this didn't necessarily come out of 2025, but it did come out of the act that changed December 20th of 2019. Required minimum distributions changed in terms of how we take them out. The elimination of the stretch IRA, those kind of things. But the tax rate being dropped for another 5 years before it goes back up is a critical part of you understanding how to distribute money out of the 401k plans, if you will. The second critical element, go ahead, Angie. I saw your mouth start to move.
Well, I mean, we had some questions about it, and I knew that, we're saying that most of these provisions expire in 2020 or 2025. Does anything stay? Is there any?
It'll all be up in the air. It'll go directly back to where it was in 2017.
Well, is there a chance it gets voted back in?
There is a chance of it. Just remember, it takes 60 senators. And I still don't know how they got the CARES Act passed, quite frankly, that came out March 27th of 2020. I think it was a grace of God and a lot of goodwill in the back part of Capitol Hill that the politicians don't get credit for. I mean, they all knew it was extreme. They behaved like little children, in my opinion, in 2008. That cost us money as an economy we'll never get back. In this case, even though social media said this side was bad and that side was bad and, people were playing games, they worked together to get that CARES Act out, or it never would have passed. I don't think in tax policy, because there's so much animosity between the two beliefs. And in all fairness, the CARES Act, putting trillions of dollars in the economy, tended to help people who already had resources more than those. It helped people who didn't have, right? I mean, my daughters don't have, and both got stimulus checks, and it very much helped them, in their lives. Barb and I didn't get a stimulus check, but we got other benefits because businesses were kept alive and our 401ks were protected, where younger people don't necessarily have those. So I think it's going to be very, very difficult to keep that in. Here's my commitment for you. I like to run series, themes, if you will. Mm-hmm. And so what we're going to do over the next 5 weeks is each week we will have one of these as a segment, and things that you need to consider about 2025 in each of the 5 critical elements. So the 5 critical elements: your life after work, the annual tax plan, and I do mean annual. We send out a tax package every November. This year it's going to be October to get you ahead of the game of things that you need to consider before the end of the year. The third is the investment playbook. Things need to be looked at differently today than they're going to be looked at in 2026 after the sunset. The fourth thing is life happens, just like we talked about with life insurance. It's the good, bad, and ugly of life, not stuff that you have to deal with every day. And then last but not least is the legacy plan. Probably the most 2 impacted areas of the new tax provision are in the legacy plan and in the Your Life After Work column. And looking at those 2 are critical. So my newspaper column that I write weekly, hopefully you're getting that, as well as these 5 segments will make up a segment on each of the next 5 shows. Then we'll have it taken together and prepackaged so that you can get it in one podcast if you want to, as well as checklists to think about each of those things. So I know what I'm doing for the next 5 to 6 weeks is a gift for you folks that listen to the show. Do not forget, on July 7th, we will start streaming the show live Tuesday evenings from 5 p.m., 6 to 6 p.m. Eastern Standard Time. That will be coming out. We're very, very excited about that. Regardless of where you listen to the podcast today or the radio shows, those will be the same times. Nothing will change. It's just if you're part of the streaming one, you'll be able to interact, ask questions. We'll have to go to commercial break for the radio, but we'll be able to introduce with you, and you'll be able to see us. Now Angie's worried about her wardrobe and her hair.
I can't wear a hat anymore.
I will not make any changes in my wardrobe. Bob wore hats forever on Q95. I don't see the problem. Wear the hat. Wear the hat. Hey, you are listening to Consider This Program. Give Angie a call, 800-928-4001. Get signed up for your Next Steps meeting.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Hey, I'm going to have a tough time when we're filming this live or streaming this live on our webisode on Tuesday nights from 5 to 6 p.m. I'm not saying good morning, right? Because the show's always been good morning, except when we were on WHBU for a while at 5 p.m. at night, and I think I still said good morning most of the time. So it will be a new thing for me. Angie, Father's Day, right? You didn't do a lot. That's a sad thing as I think about that. It was my father's birthday. We lost him about 20 years ago, and Father's Day. So it was great to be able to see my kids. It was sad not to be able to see Barb's dad and my stepfather. Two are in Florida, and Barb's dad and mom are way over 80 and just not ready to come out into the world yet, which I totally get, by the way.
Yeah, it was hard. I mean, I lost my dad early, like back in high school. And then what made it extra bad this year is that, I still have Ava at home. My high school daughter just graduated, and she lost her father, within the last 18 months. So it was tough.
It's a tough day. We forget that sometimes in church when we talk about fathers and mothers, the people who tried to have kids and couldn't, or the people who've lost their parents or have lost a child, and we always try to be respectful of that. I will tell you, you have worked, and I want to commend you and the team. We spent a lot of energy, you and I especially, 3 or 4 weeks ago, putting together the Get Smart About Your Retirement Challenge. That's coming back to you. You can get signed up for that again by calling Angie at 800-928-4001. But this coming week, starting June 29th, going through July 2nd, so 4 nights, Monday, Tuesday, Wednesday, Thursday, starting at 6 o'clock for the 8 to 12-year-old children, and then at 7 o'clock for those that are 13 to 18.
And it's just a 30-minute class. We're just allowing a little extra time in there.
This is stuff that we believe people should be learning in high school and in school to better understand their money. And so grandparents, I guess I'm talking to you, right? Most of you who are taking the time to listen to the show have resources. And it doesn't matter if you have 100,000 or if you have 100 million or somewhere in between. What you have matters a lot to you. And eventually, God's going to call you home. And when that happens, other people are going to get money. And what I find is more often than not, people say these jokes about how kids go and spend money or do things. The tragic errors that I can share with you that people made over inheriting money is simply phenomenal. And it is not necessarily them wanting to go buy a car or go to Vegas or go do stupid stuff. It's that they don't have the financial education and wisdom to make decisions. So I try to work. We have a family program with the families that we come in where your kids and your grandkids actually get the same rate and attention that you do. And meetings separately from you so they can learn to be able to handle money before they inherit money. This challenge is really designed to get them in the right start. You simply cannot make up for compound interest. Go to our website at yourlifeafterwork.com. On the main page right there, get kids signed up. It's free. We look forward to being able to see about 60 kids signed up right now. Give Angie a call, 800-928-4001. God bless and have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800